All right, welcome everyone. This is Bob Maurer. It is about 1:20ish my time on Tuesday, the 1st of April. I want to do a deeper dive into some strategies that were benchmarked recently for the seasonal window. It is strategies number 352, bear spread in corn, and 353, bear spread in dialing into the portal. Do the most current PDF version, and sitting right here in the bottom rows, 352 and 353. See the margin requirements, entries, exits, length of the window, and then we've got our entries. Final two columns have the P&L, estimated P&L. All right, so let's hop over the chart and see. Up. First thing we'll do is corn. This is strategy number 352, bear spread in corn. Long December, short September, so same marketing year. Margin requirement just shy of 200 bucks. And then our entry and exit, basically a risk reward for whether you're a conservative entry level trader or more aggressive if you want to in. All right. Backstory on this one, it's been profitable 13 out of the last 15 years. The two losing years were 2016 and 2011. When I size up the incoming price and the chart structure for those 2 years relative to the one you're looking at right in front of you, which contracts will be trading and the spread will be trading, I don't see a whole lot of correlation in terms of the chart structure, shape of the chart, and what's been happening, whether it's been trending, non-trending, or not. In terms of the incoming price, yes, I do see some correlation in 2016, but not really for 2011. In 2011, it came from a higher price. So net, I don't see a whole lot of concern probabilities of those two losing years repeating. Can it happen? Yes, of course it can happen, but it's just my assessment. So I feel like this is a good to go forward with, especially because we're looking to get short and it's been on a downtrend. So we're kind of trend. The benchmark to stop range. So our benchmark here is where the seasonal starts on day 0, which it's settled at -7.5, and our stop is up here at -3. That's a $225 range. 14 out of the last 15 years, that would have been ample room to stay on board. The one off year that it would not have been ample was 2011. That was one of those losing years. And at one point, this spread was unrealized loss of $1,350, which is pretty extraordinary because the balance of the other years, at worst, the average unrealized loss at some point during this window was only $125. So that was, say, quite substantially higher, 8 times higher than normal. So 2011 seems like one off, pretty extraordinary year, which hopefully won't happen to us. Okay, so what are we looking to do? We're looking to get short. Where are we looking to get short? Two levels. One is -7 cents, and I see we've already been through that, so I'm not going to walk this forward as if we're filled, as this is just so -7 is the first level, -5/4 is the second level, -3 is our stop, and then our targets are down here at -9.5. Okay, -7, -5/4, etc. And we are looking to get on board with the trend. So the market basically had a pretty good lofty push to the upside throughout early part of the year, had a good break. Tariff talk, also the fact that the Brazilian crop seems to be in pretty good shape at the moment in terms of just getting it in the ground. That's the Safrinha corn crop. And that looks pretty good. So I think some concerns were taken out of the market of whether or not things are going to move forward down in Brazil, but also concerns were added to the market in terms of the potential for tariffs to have some kind of negative effect in the corn market. Now, that all remains to be seen how it actually plays out, but that's just the take from the dramatic move. So we're looking to get on board with this downtrend. We need to see a bit more of a bounce and then a break on down. So it's trend following, and the seasonal is in the driver's seat. So we'll see how this one plays out. So got the risk reward, got the backstory, and then we have our entries and exits. So everybody should be on the same page for this one. Then the second one I want to introduce is Lean Hogs. This is bear spread Number 353, and it's in yellow here. Long July, short June. Margin requirement just shy of $800. You got your risk reward profile there in terms of the dollar impact of this. And then backstory on this one, it's been profitable during the seasonal window 14 out of the last 15 years. The losing year was 2021. In 2021, I don't see a whole lot of correlation in terms of the incoming price. Our incoming price is negative 77, and in 21 it was higher. And then in terms of the structure, a little bit. So this is kind of rallied into this seasonal from a lower level, but still it's rallied. And then in 2021, it also rallied into the beginning of the seasonal. Now, the big difference is when I look at the actual underlying futures contract, the lead month there, June contract. So I'll just look at the June contract for 2021 and compare it to the June contract that we're trading here in 2025. See if there's any correlation between those two. And I don't see it. In 2021, the underlying future rallied 25 cents into the seasonal window, whereas the June lean hog for 2025 hasn't done anything close to that. So there's a big difference. So for that reason, even though both the spreads are rallying into the seasonal, there's a different construct of the lead month going into the seasonal. So I'm not as concerned that it's going to repeat itself. And if it does, we got to stop anyway, so we should be good to go. All right. Benchmark to stop range. How much room are we giving this? The benchmark was negative 77. Our stop is at positive 67. That's a $580 differential, and that would have been enough to stay on board 15 out of the last 15 years. Okay, so we are giving it ample room relative to last 15 years worth of data, in my opinion. All right, so all that sets it up to why we're doing it. It also gives the math in terms of the risk reward here for the strategy. Now, what are we looking to do? We're looking to get in at the benchmark. So that is negative 77, and we're obviously a little bit higher than that. So maybe better tomorrow. Get in tomorrow. And then the second level will be negative 7.5. Stop is up here at positive 67.5. Our targets are down here at negative 1 to a negative 17. So we want to see a bit of a rally and then a break. And really, we could either look at this as a downward trending market, slightly downward trending, or more of a range. So it's really your choice, I guess. If I look at this, I see where the meat of the matter's been in here, which is a high of, say, a dime and low of negative $1. So about a $400 range, give or take. And the market had a probe to the downside and quickly retested it. And then we're pushing back into that range. So maybe what it's going to do next is test the high end of the range and then fall back down. Great, and align with our seasonal tendency here. So that's what we're looking for it to hopefully do. So we're going to call this range bound. And we're looking to get short. Yet seasonal tendency is in the driver's seat. All right, so there's the risk reward profile. I gave you the backstory on this one. And then also we've got the entries and exits. So everybody should be on the same page. All right, so that is a brief introductions of strategies number 352 and 353. If you have any questions, comments, anything of interest, feel free to let me know. I am going to leave it there. And thanks so much for watching.